Yes, what's good, my people? It's your boy Daniel FX here. Welcome back to the channel. It's episode 10, day 10 of the Indices Bootcamp. Hopefully, you guys have enjoyed the series up until this point. I do apologize about the delay between episode 9 and episode 10, but I've just been crazy busy with a bunch of stuff this past week, so I do apologize. This is a free series on YouTube, so I am trying my best to get these episodes uploaded, but at the same time, it's not a major priority because it's a free series on YouTube. Like, I'm not getting paid to do this, so I'll make them when I got the time. So hopefully you guys can bear with me, but let me know in the comments if you guys enjoy the series. Let me know if you're actually waiting for more episodes to come out, etc. And maybe it might motivate me to drop some more consistent, more frequent episodes. But without further ado, let's get into today's episode. Now, you probably already know what the episode is about from the thumbnail, but this episode is going to be a combination of backtesting, data collection, and a little bit more mindset stuff. We are going to go through some technicals, and I'm going to give you some actual live, well, not live, but I'm going to give you some trading examples right here in FX Replay, just to give you some example trades. But like I've been saying this entire series, the technical is really not that deep. So far, what we've covered in the past like nine or eight episodes, the technicals that I've given you, daily structure, daily sentiment, impulsive and corrective waves, key levels, reading depletion, understanding like the lower time frame sentiment as well and the behavior, that in and of itself is enough for you to trade with and make money. Combine that with like some more technical, like maybe an EMA cross or maybe correlating with the dollar or just some of the other stuff that you've been through, it is definitely enough of a system for you to be profitable with. Now, just before we get into more technicals and we get into this whole list and everything, I want to point out two things. Number one is that I, at this current point, have not given you my entire system yet. So there's still more aspects of my system that I have not mentioned. There's still a whole smart money side to it. So there's looking at factors like liquidity grabs, looking at order blocks, looking at fair value gaps, inefficiencies, psychological levels. These are all like elements of my trading. But there's a reason that I didn't mention it, and that is because foundationally, price action is the main aspect of my trading. That is always the bulk of it, is the price action, is reading the candlesticks, looking at the behavior. Understanding this is my trading strategy. The smart money stuff is just additional knowledge that I have that's in the back of my mind, and I can just see it on the chart. And in some sort of scenarios, in certain setups, in certain trading opportunities, it's advantage. What's the word I'm looking for? It's advantageous for you to know what the smart money stuff is, so you know how you can better use the break and retest stuff. So that's the best way I can kind of put it. Now, for the purpose of this Indices Bootcamp, I'm not going to really get into depth about the smart money stuff for two reasons. Number one is because there's a bunch of smart money like teaching out there. You can go to ICT's channel, you can go to any like YouTube channel out there, and a bunch of people teach order blocks, teach fair value gaps. They teach these institutional concepts probably better than I can teach them because I'm not a smart money trader. And on top of that, is also I cannot give every little part of my trading strategy for free on YouTube because otherwise the paid mentees and whatnot are going to get very upset with me. So I'm going to allow giving out literally everything. But like I said, foundationally, the price action stuff and what I've given you up until this moment is more than enough for you to go ahead and start to build your system on and then start to build your own unique approach to the market. So definitely don't think that I'm like gatekeeping, I'm preventing you from being profitable because I've got some secret information that I haven't given you. Like, nah, the price action, if anything, I could have given you guys the smart money stuff and been like, this is the main aspect, and then left all the price action and the market sentiment and stuff to myself. But this is the main thing. It's price action, reading market sentiment. And again, mainly it's the approach to the market. Again, nothing. Look. Let me turn my chair around because I really want to talk to you here for a minute. And for those of you who are watching this, I've said this for the past 9 episodes. I'm probably going to say it for the next 10 episodes, but it's not about your strategy. It's not about your system. It's not about a secret technical. It's not about a secret indicator. This is only like 10% of the equation. It's very, very minor. Yes, there are certain strategies that are better than others. Yes, there are certain methodologies that may give you a higher win rate. There are certain systems that may make you a little bit more money, a little bit more percentage. But that's not what we're currently doing right here. You guys who are currently watching this are all unprofitable traders. So that means you're all currently in the negative. Your only goal right now is to get above the negative. You're trying to get into the green. You're trying to make profit. You're not concerned about maximizing profit and making a ridiculous gain. You're not concerned about optimizing your system and making 15, 16% months. You're just concerned about passing an evaluation, passing a funded, and making a payout. That is it. I'm assuming that's the majority of you guys. Your goal is just to pass any size evaluation, get funded, and make a payout. The price action stuff and this simple 1 to 2 system that I've been showing you guys over the past 10 episodes is enough for you to do that. and it's simplified in such a way that it allows you to focus on the psychology and the mental aspect, which is what's going to actually get you funded. Because having a super complicated ICT strategy or having some crazy technicals or whatever that you're looking at, it gives you that mental cloud, that mental like fog where you're not quite sure what you're doing. There's so many elements that go into your trading that there's always an element of doubt. Have I done this right? Have I done this right? Is this correct? Is this correct? Is this what I think it is? But when you have such a simple strategy that's simply just based off a price action, based off a higher time frame bias, and it's stupidly simple, you can always see on the chart, is my strategy there? Yes or no? That is it. Is it a break and retest? Yes or no? Does this look like one of the three setups? Yes or no? And it's a very easy, clear distinction that you can make. And that's how you can start to take less trades, take higher quality positions, and actually get yourself funded. You see what I'm saying? So without further ado, we're going to end a little rant and we're going to hop right here. Now, for those of you who don't know what this is FX Replay. It's a very, very useful software that I'd recommend you guys get. If you're currently backtesting on TradingView, I'd recommend get rid of TradingView and get FX Replay because this has a lot more beneficial features than TradingView. Now, if I go back to the main page, this is your FX Replay main page or your home page. You can come here to create a session and it'll bring up this little tab right here. You can then enter in whatever account balance you would like. Now, I'd highly recommend that if you're planning on taking a specific funded account size, for example, let's say you're training to take a 20K evaluation, enter in $20,000. Try and train your brain to see those specific numbers to calculate that specific percentage risk and just have it in your mind. And just a good little mental trick to kind of get you prepared for what you're doing. So obviously your boy's out here trading with millies, so I'll put a 1 million account in it. But yeah, just for argument's sake, we'll just put in 10,000. That might be 100,000. You can then select whatever pair you would like. This has literally everything on here. But for the purpose of what we're doing, US30 is definitely what you're after. If you're looking for NASDAQ, it's called NAS 100, I believe, on here. Just bring it up. Yeah, NAS 100. So this is NASDAQ. You can then select any period that you would like to trade. So again, and a major benefit to this over TradingView is you can actually go much further back in price. So I can go all the way back to 2000 and look at the 5-minute time frame back in 2000. If you go to TradingView and you try to bring price back like more than like 2 years and goes like a 5-minute time frame, it will jump you forward to current day and current like price action because TradingView don't actually store historic price action. They don't store historic data. Which means you literally can't look at that sort of information without having FX Replay. So again, even though it is $28, and I know a lot of you guys don't want to pay for shit and you probably don't have the money, but I recommend if you only have like $30 to your name and you want to invest it into trading, don't put it into a trading account, put it into this. This is going to get you a lot further along than doing some other BS and putting it into a personal account and trying to do anything crazy. Again, invest in your education. So important. Cool. But anyways, this is all some pretty self-explanatory information. Again, I do have an entire video about FX Replay and the pros and cons to this. So I'd recommend you watch it after this video if you still need a little bit more clarification. I think the video on my YouTube is called the most what did I call it? So I'm not even gonna cut this out of the video. Yeah, it's called like the fastest way to progress as a trader or the fastest way to learn trading, something like that. But the thumbnail's like a half green, half red. So if you're looking for it on my YouTube, it's half green, half red, and it's like the fastest way to learn trading in 2023. But yeah, cool. Anyways, now that we're here on FX Replay, initially when you load up your FX Replay, you will naturally have some volume down here. You'll have the little green and red bars that come up. I'd highly recommend always come to the top left and delete the volume because it's irrelevant. It just takes up space on the screen. There's no need for it. Now, when it comes to FX Replay, there are a couple of main benefits. Now, benefit number one is you can actually play price forward as like a rolling feature. What do I mean by this? Well, I mean, if you've ever backtested on TradingView, you know that whenever you click the play forward button, the candle jumps. It doesn't form, it doesn't roll, it just jumps. It forms the entire candle at the end of the candle. Obviously, the live market doesn't do this. In a live market, the candle moves, it wicks, it rejects, it has a little play, and then it moves. You see what I'm saying? So especially when it comes to practicing your entries and practicing your exits, it's so important to have a software that can mimic a live market and mimic price action or mimic wicking, etc. So you can practice the execution and the exits because it's more closely to what you're actually going to be doing. So that's a major benefit to this. On top of this, you can also actually place your trades on FX Replay. You can actually place a position. Now I'm going to show you this here in a minute as we come to find a position, but tons of benefits to FX Replay. Take my word for it. Now, What we're going to do right here is I'm going to give you guys a live demonstration of a trade. We're going to go through the whole thought process, essentially the trading plan. We're going to start to build together the building blocks of the system that I've taught you guys. So currently, using the knowledge that I've given you, we're going to go through the trading plan. So step one is what? Well, obviously you guys can't respond to me, but hopefully you're sitting there behind the screen saying market structure. So right here on a daily time frame, step number one, always step number one of the trading plan, market structure. What is the market structure? Is it bullish? Is it bearish? Now I'm going to give you guys a couple seconds to decide what you think is the current market structure. Bullish, bearish. Now I'm willing to bet that a lot of you guys said bearish, and while you are kind of correct, you're incorrect at the same time. And again, this is what a lot of people do when it comes to the indices. You see the structure, naturally you think, yo, this has to be bearish. We're in clearly a downtrend, price is pushing lower. However, like I said in like episode 2 or episode 3, when we're looking at the indices on a higher time frame, you're only looking at the current price action. You're only really looking at like the past 2 weeks, the past, call it 12 candles. So if we take that into account, the past 12 candles have only really been this sort of section right here. This right here is our past 2 weeks of price. Now, granted, this is definitely majorly bearish price action. It's definitely a downtrend. But if we disregard that information and we look at the past 2 weeks of price, what's actually been happening? Well, prices actually been moving sideways. We've attempted to break lower. We've kind of failed that. We had a little push to the upside, and price is still kind of fumbling about. So I would say the current market structure is a little bit indecisive, but I'm beginning to get an idea that price is beginning to deplete. It's beginning to lose a bit of that bearish momentum. Now, again, the same way that you guys do the market sentiment and understanding candlestick behavior on a smaller time frame, you can apply a similar concept to a daily and just use that as your market sentiment. So what I mean by this is, again, really paying attention to each individual candlestick, and again, only looking at the past 2 weeks. What has actually happened here? Well, price has had and again, coming into session 1, what are we speaking about? Impulsive and corrective waves. What's an impulsive wave? Well, it's when price pushes very small wick projections, large bodies, etc. It's a very certain movement. Right here, we have a nice bearish impulsive movement. Granted, we're still leaving various wicks and the bodies aren't like crazy strong, but we can see we've had a nice solid bearish movement for about a week and a bit right here. Price is pushing bearish. We then reach this little area right here, and what does price begin to do? Well, the candles lose a bit of momentum, the sentiment begins to shift a little bit, and we have an attempted push right here. We have a little midweek reversal on the Wednesday. Price essentially kind of bottoms out right here. We then end up taking that low and immediately have a reaction back up. So you have another little impulsive back away. Price comes back, and instead of breaking the structural low and continuing lower, we stall out. So in other words, price is now looking like it may be, and again, we're not going to jump to this conclusion, but maybe creating a higher low and it's looking to continue higher. You see what I'm saying? Now, again, we do not know this for certain. I'm not going to start trading based off of this information, but just based off of the current behavior that I can see that right now, price is beginning to lose some of that bearish momentum. We're now printing indecision candles. The past 4 or 5 days of price have been very indecisive and they've been very slightly bullish. Combine that with the fact that we haven't broken the previous low and we haven't continued the overall like shorting movement, it's now a potential that price may look to continue higher. Now, granted, that was a little bit of over-analysis right here. I'm just really trying to outline to you how you can use these candlesticks to really get an idea of where price wants to move. But like I said, your first step is just market structure. Now, if you come across a market like this, where there's no clear structure, it's not clearly bullish or clearly bearish, very, very simple plan. And that is you just wait. You do nothing. Whenever in doubt, whenever you can't see price clearly, you do nothing. You just wait. So right here, all I would do is simply skip forward to the next day and I would wait for the next candle to open up. So right here, skip forward to the next day. Now, this next day actually changes things a little bit. So going back to the same process, step number 1, market structure. Well, I would say now that we've printed this quite large bullish candle, I would say now the market structure has low-key shifted because now it's kind of confirmed what I was thinking. We've essentially left equal lows down here. In other words, price has failed to break lower, and we've now had quite a large, strong bullish candle. So we're now coming into step 2 of the trading plan, market sentiment. What's the current behavior of the market? Now, usually when we're talking about market sentiment, we're talking about the past 3 candles. What the past 3 candles done? Well, right here in this example, the past 3 candles, again, we've had an indecision candle, which would equate to like low volume. It would equate to price not really knowing where it wants to move. We've had another indecision candle, and then we've had this strong bullish candle that attempted to break the lows, because again, we came the whole way down, attempted to break the lows, unable to break, and we've now pushed up. So using this within the correct context of we're moving sideways, we've now had a strong bullish push above. Again, the idea is that now price wants to continue higher. Granted, I want to point out that right here, this is not even necessarily the highest probability day for you to trade. I would consider this day right here a little bit more of an aggressive day for you to trade. I would say if you're really conservative, maybe you're on like a fresh evaluation, 200K or something, and you just wanted to take a really high probability trade for your first position, I personally wouldn't trade this day. What I would do is I would wait for a strong break of structure. So you see this little structural high that we left right here. I would probably wait for this structural high to get broken. And once we break that high, 100% the market structure has shifted to bullish. And then the idea is that the market sentiment would also be bullish, and it would be a very high probability day to trade. So furthermore, let's go ahead and do that right here. We'll actually skip forward and we'll see if we get a closure above. Right there, we didn't get a closure above. It's not a day that we would trade. So we'll actually just skip forward and we'll see. All right, cool. Right here, perfect. Skip a little bit further. Right here, perfect, cool. Back to step one, reloading it. Now notice, furthermore, notice how from the day that we started looking at this, which would have been around here, to the current day, this is like 4 or 5 days in between. Now this is 4 or 5 days that you may have not have traded. 4 or 5 days where you may have just set out the market. Now, I understand that when it comes to backtesting, it's very easy for you to sit here and spam that button and just play price forward and like skip a whole week of like dry price and just get forward to the most high probability trade. But in an actual live market, it's a lot harder for you to sit there actually every day, come into the market, look at price and be like, yo, you know what? I'm not going to trade. I'm not going to take a position. But that is what's going to make you profitable. Again, this is a major tip for you guys watching this video right here. But what's going to make you profitable is not your ability to find a good trade, but it's your ability to avoid the bad ones. It's your ability to not trade when you can't see your trading setup. A lot of people can find a successful trade. They can find their trading plan. They can find their unique setup. But then also the other 70% of the time, they're just finding some nonsense and they're just taking it because they feel like taking it. But it's your ability to do nothing when the market's not giving it is what's really going to get you there. Anyways, back to this step. Step one, market structure, bullish. Very, very easy. Market sentiment, also bullish in this example. We can see the past 3 days, bullish price. We've had a nice clean break above structure. We've had a sentiment shift. Everything makes sense. We know 100% now the higher time frame is telling us we are bullish. That is step one. Step two, out the way. Granted, right here, there would be a step three, and that would be you'd be looking at the dollar. You'd be trying to confirm this with DXY or trying to correlate with the dollar strength or dollar weakness. Granted, we can't do that on FX replay because we're only looking at US 30, but that would be your third step in a live market. Granted that your third step aligns and the dollar isn't doing anything crazy, there's no high impact news or anything. We then go to step 4 of the trading plan, and that is to zoom into the hourly time frame. So right here, we zoom into the 1H. Now on the 1H, you want to fast forward until pre-New York session. So again, this is a little bit of a backtesting 101 for you, but you don't just randomly start trading. When it comes to backtesting, I see way too many people do this. You don't just randomly start executing positions. You find exactly where you're meant to be at. You find the set period that you're looking to trade, and you only trade that set period. Now, we currently haven't been through like trading sessions and trading characteristics, and we haven't been through a bunch of those, which we're going to get into for some later sessions. But for the system that I'm teaching you guys, your main trading period, or furthermore, your only trading period, is from the times of 12 o'clock, so 1 hour pre-New York, to around 3 or 4 p.m. So maybe an hour and a half after stock exchange open. That is it. If you don't find the trade by 4 p.m., there's no trade. If you find the trade before 12, that's still London session, so we're not looking at that. From 12 to 4, max. It's like a 4-hour window. Usually, if anything, I would say majority of trades actually take place from like 12 to like 1:30. So I would say it's actually only like an hour and a half, but sometimes you do get the occasional position that takes place after New York Stock Exchange. So coming right here, you skip forward until it hits 12. So that is 9, that's 10, 11, and the next candle will be 12. Now, don't accidentally skip the 12 a.m. candle. Don't accidentally sit here on the hourly and spam too far forward. Otherwise, you'll skip the candle. But as it hits 11, you can then go to like a 15 or a 5, and it will be 5 minutes before 12. So yeah, step 4 of the trading plan. Once you're around your appropriate trading session, you're looking for a point of interest. You're looking for some sort of key level, some sort of area that makes sense. Now, again, you need to remember what it is that you are trading. We are trading the indices. We're trading very fast moving assets right here. That means that some of the key levels that you would draw on a Forex pair do not make sense to draw it on an indice. Now, for example, on GU, on EU, on some of the major Forex pairs, you may be looking for a very deep retracement the whole way down here, and it's reasonable for that to happen with the New York session, etc., etc. But again, we're trading the indices, and the indices don't tend to have deep retracements. We don't really tend to have a major movement. And again, this is why you start your analysis around New York Open, because wherever price is currently at around New York Open is probably going to have a reaction around this sort of level for New York Open. You see what I'm saying? So right here, you can see it's 1 hour pre-New York. There's an accumulation of wicks. There's also another accumulation of wicks, accumulation of bodies. And look at that, there's also a previous structural high. So it just makes sense to have the key level here where price is currently at, instead of having it lower and waiting for price to come to that level. Now, I'm not going to assume that this level is going to hold, but I am going to just look at this level first and foremost. And if price wants to have some sort of movement like this, for example, I will simply readjust my level and look a little bit lower and a little bit lower, and we'll continue that process until it has a complete change of character and we're just no longer looking at the same trade. But you're always looking at the highest level. The most common, the most current level, most recent price action is the main level you're looking at, especially on an hourly time frame. So I'll call right here, hourly point of interest. Now, there is also an inefficiency right here, or a gap, market gap. It depends who you want to talk to, it depends who you ask, but there is a bit of a gap here. That is a separate topic by itself that we're not going to cover in this session, but I just thought I'd throw it out there for you ICT guys. Cool. So this is literally the only thing you're doing on an hourly time frame. Point of interest, that is it. On an hourly time frame, another thing that you can do is you can just look at overall structure and try to find a major point of interest. So maybe like a target, or maybe like a huge imbalance or something along those lines. But again, it's not really too important. It's not really something that I necessarily do on an hourly time frame. But sometimes you can just see a very key piece of information on an hourly. But in this sort of scenario, that's literally all we're doing, just that one key level. Cool. Now, after you got the key level down, you then go to either a 15 or a 5 minute. Now, dependent on how clean the price action is, you either use the 15 or the 5. If you can see it clearly on a 5 minute, use the 5 minute. If you can't see it clearly on a 5 minute, if it's a little bit messy, etc., defer to the 15 minute. But I personally always try and use the 5 because it just gives you a little bit more accurate data. It's a little bit more precise. But sometimes a 5 minute is super messy and it just makes more sense to look at a 15. Now, what are we actually doing here on a 5 minute? Well, we're looking for 3 things. Again, going back to the trading plan, going back to what we were covering in previous sessions, we've got a higher time frame bias, we've got a higher time frame sentiment, the dollar is in line. So we've now got 3 reasons for us to trade in the buy side direction. We've now also got a point of interest. So that's the 4th reason for us to trade in the buy side direction. Now we're looking for that 5th reason. Now that 5th reason is price respecting the zone. So price coming back, tapping into this level and holding the level. So right here, you can see we haven't tapped into the zone. We're going to simply come back and wait for price to tap in. Right here, we came back, we tapped in. Now, again, I don't want you guys to sit here, see one little wick rejection, one bullish candle and be like, boom, time to buy. A lot of people do this. You can do it. It works sometimes it doesn't work, etc. But one candle in and of itself is not enough information for you to go off of. That's not enough of a confirmation for price telling you that it's holding that level. Again, coming back to what we were saying in earlier sessions, we're looking for one of 3 things, or 2 or 3 things rather. We're looking for depletion, keyword depletion, so a long accumulation, price holding a level. We're looking for a change of character, so price to form a structural low, form a structural high, and then break it. So in this example, we'd be looking for price to come here, hold the level, accumulate, etc., etc., and then have that little 5 minute breaker structure, or that 5 minute change of character, depends what you want to call it. But the idea is you have that clear shift, that clear indication that tells you, okay, cool, we've accumulated, we've held it, now we're breaking. We'll see right here if we get the example. Now, I also want to point out, this is not a pre-recorded example that I found. I haven't sat here and backtested this. It's just a random point I found on US30. So we'll see if the example violates me or not. Hopefully it doesn't, so I can get my point across. But this is the live market. Or not the live market, but you see what I'm saying? Cool. So you'd sit here and you would wait for price to hold the level. Now, obviously, price isn't always going to hold your level. Sometimes you're just going to get violated. Right here, I want to point this out. This would be a sentiment shift. I would consider this a sentiment shift. Now, again, I want to point out how it's not necessarily as clear as the example I just showed. It's not necessarily the case of price holding a level perfectly and then having a super clean change of character like this. But in this sort of scenario, if we look to the left, what has actually happened? Well, prices came down into the level, forming some bearish structure. We then broke the structural low right here, had a nice little low movement, and price came up and had a nice little like accumulation, nice little area of like depletion. Price, it kind of faked out like it was not wanting to push higher. And I'm sure that this in and of itself, and again, looking from a seller's perspective, you always want to flip the buyers. But I'm sure this little like 5-6 little wick rejections combined with a bearish candle definitely encouraged a couple of people to sell and enter short positions. Now, as price comes down, instead of breaking the structural low, continuing lower, what happens? Well, we have a sentiment shift and price essentially has a change of character. Now, again, you can't really see it too clearly because they're not necessarily bodies, it's more wicks and it's the general sort of like movement. But essentially what has happened is this movement right here. We've had bearish price action or bearish market structure, created a structural low, we failed to break lower and had that change of character right here. So you can see if I just highlight it for you, right here, this would be your structural high, that would be your structural low, and that right there would be the break of structure. So right there is step 5 of your trading plan, or step 6 low key. Now in this sort of example, there's not necessarily any sort of clear depletion. The depletion is actually in the opposite direction on this one. But the general sort of takeaway from this is that we've held the level and we've now had a change of character, and we're now slowly starting to print a little bit more strong sentiment bullish candles. The bullish pressure or the buying pressure is getting a little bit stronger and price is pushing to the upside. So this right here would be a valid entry. Now I know it's crazy, we haven't been through much. Daniel, where's the church? All right, it's easy. This is it. This is literally it. This is literally it. Daily time frame, daily sentiment, hourly key level, dollars in line. Key level's been respected. It's been tapped into. We've had a sentiment shift and a change of character. Now, with all of that probability behind us, we simply enter on a strong continuation candle. Now, a strong continuation candle in this sort of circumstance would be this one right here. Oh, messed that one up nicely. It'll be this one right here. Arguably, you could have entered on one of these two, but these are a little bit more indecisive candles that still got upside wick projections. This one right here that we just recently printed does not have an upside wick projection. At this point, I would usually confirm on a 15-minute time frame. Now, what I mean by confirm on a 15-minute time frame is I always want to zoom out and just make sure I'm not missing any key piece of information. Because sometimes it may look super clean on a 5-minute, and then you zoom out to a 15-minute, and you realize that on a 15-minute, you're rejecting a blatant key level, or it's accumulating, or like you can just see a different piece of information that you could not see on a 5-minute. So right here on a 15-minute doesn't really give me too much information. If I was being a little bit more conservative, or if I was trying to trade a little bit more intraday, I would wait for the exact same process, but just on a 15-minute time frame. So the same way that we waited for a change of character, you could do the same thing and wait for the 15-minute change of character, which would be right here. Now, granted, this would definitely take longer, and it would mean that you'd miss a couple of pips, you'd miss a little bit more of the trade, but that would also be a valid way for you to enter this position. It would just mean that you'd be entering more on an intraday perspective, and you potentially run the risk of either missing the move if price moves too quickly, or you just may not get this entry. So it just depends on what you're going after. In this sort of scenario, I would be happy to sort of execute this sort of position because it makes sense. Now, cool. Going back to what I was saying, 5-minute time frame, enter on the candle rollover. Now, what I mean by candle rollover is you never enter while a candle is moving. Granted, this is FX replays, we're in backtesting mode, but in a live market, price moves, you have candle open, candle closure. You never enter mid-candle. You always enter on the candle closure. So as the candle hits 0 and the next one opens up, you enter. That is it. So you enter right here. Stop loss always goes below structure. So below structure would either be below this little low right here, or if you're looking at the 15-minute structure, you would put it below this low. Now, you don't sit there and mock it and have it literally on the pip, but give it a couple pips of breathing room. Have it be reasonable. The idea is that if price comes down to this level, You are not in the trade that you thought you were. We're not in the uptrend, and we don't want to be in that position. That is it. So stop loss is safely below structure, and you simply target a 1 to 2. Very, very easy, 1 to 2. Now, a couple of things that we need to go through right here. Number one is that your stop loss can be in a number of places. There's a number of correct places you can put your stop loss. Now, right now, I don't have the EMAs on my chart, but there's probably, I'm willing to bet, there's some sort of EMA crossover happening at a similar sort of level. That could also be one of your entry requirements or one of your entry confluences. All right, there it is, and we're back. All right, apologies about that. Yeah, like I said, EMA cross could be also happening at this level. You can also put your stop loss just below the EMA. But granted, this sort of stop loss positioning does increase your risk reward ratio, so it does increase your potential profit, but also increases the potential chance that you're going to be stopped out on a position. Now, believe me, and I've been trading for 5 years, there is nothing more irritating than having price stop you out and then go in your direction. You should never be stopped out and then have price go in your direction. In my opinion, the only time you should be stopped out is when you're just completely wrong about the trade. You were just wrong about the bias, you weren't trading in the right direction, price reversed, whatever, you entered off the wrong point. It is what it is. Price goes against you. But what you shouldn't have is price tag you out to the pit, tag you out within the general sort of region, and then immediately move in your direction. That shows one of three things. That shows you either entering late, your stop loss is in the wrong place, or you just got really unlucky, really and truly. But typically speaking, I wouldn't go for this unless I had a very specific reason as to why I wanted to be more aggressive. My personal philosophy and what I'd recommend you guys take away is I would always rather take less of a profit. I'd always rather go for a 1 to 2 instead of a 1 to 4 and secure the 1 to 2. So secure the 2%, then go for a higher target and maybe not get it. You see what I'm saying? I'd always much rather take the small, consistent profits than take the less consistent, crazy, exponential profits that come from time to time. Especially on the larger funded accounts, you guys need to understand this is serious money. When you're trading, let's say just one 200K account, a 1 to 2 is 4 grand per trade. I don't know how much you guys make, but I'm sure for a lot of you guys, 4 grand per trade is quite a good amount. So whether it's 4 grand per trade or 8 grand per trade, like which one would you rather? Again, if I asked you a question, would you rather a 65% chance that I give you 4K, or you can have a 30% chance that I give you 8K? Which one would you rather? That's kind of how I view the market. I'd always much rather take the higher probability, less profit than the lower probability, more profit. You see what I'm saying? Because again, it's that long-term consistency. If I consistently take the 65% probability option on a long enough time scale, I'll probably end up making more than the guy who takes the 30% probability of double profit. You see what I'm saying? And again, it's a long-term consistency thing, especially as you begin to stack your capital and gain more and more funding. It doesn't really matter in either case, because then you have 4, 5, 600K in capital, and then your 2% is still like 12K as it is. So like you're not really bothered about an additional 12K. Like you're chilling is what I'm saying. So anyways, stop loss below the low, targeting a 1 to 2. Now you can always target above previous structure. So right here, the 1 to 2 is kind of above previous structure anyway. So it would have been the same sort of point of interest. But let's say my 1 to 2 was like down here, for example, even though it's not, you could always just target above the previous high as well. Now, granted, on an hourly, we're still kind of accumulating. So a bit of an iffy position. But again, the idea is that if we're right about the higher time frame bias, if we're right about the direction the price wants to put, we can theoretically target way, way higher, and I can target all the way up. Now, again, I don't want you guys to get into the habit from now of like being greedy and trying to target way too much and all of this, etc. But the whole idea behind this system is if you're trading with momentum, you're trading with the trend, and you have the right bias, you have the possibility, or you have the luxury to hold your position and swing it throughout the night, swing it throughout a couple of days, etc., and just ride out the momentum. Not necessarily something I recommend doing. There's a time and a place to swing your positions. I wouldn't recommend getting in the habit of doing that, but that is the idea behind this. So anyways, right here, come up here to place order. You select your percentage risk. We're currently on a 1 million account, so we're risking 1%, which is about $10,000. You make sure that you're on a market execution, not a limit order, not a sell stop, not a buy stop, just a market execution, and you click save. Now, after you click save, you can see that right here, we're now in the order. I've got my buy level. That's my stop loss. That's my TP. Now, like I said, this is not something I previously backtested. I don't know if this is going to violate me or whatever, but we'll see. And I'm going to leave it in the video in either case because it's just real trading. Not everything's going to go in our direction, but we shall see. And that's a very nice candle. But while I'm here, let me show you guys this feature because this is what I was talking about earlier. So if I put it on like a 1 minute time frame, and I put it at like half speed, my computer doesn't want to crash on me. Yeah, so if I put it on like half speed and then click play, you can now see that these candles are actually moving. You can see the candles actually rolling over. It's forming instead of just jumping the entire candle. Obviously, I can speed this up or slow this down depending on what I want to do. Now, another feature I want to point out to you is I can also manage my trade correctly. So let's say that right here, I feel like I'm far enough in profit for me to not take a loss. So I can easily right here drag my stop loss and move it above this blue line. And now this is essentially me moving my stop loss to break even. So now I've made this a risk-free trade and I can continue to hold them the same way that you would in a live market, and you can start practicing these different elements of trading. So we'll just allow this trade to fully play out and we'll see what happens. This is actually, I think it's going to break out in a second. Yeah, there's the breakout lower. Yeah, pretty standard, pretty standard. I think right here, furthermore, just under. Yeah, see right here, prime example of why we do the 1 to 2s. You'd be surprised how often this happens. You'd be surprised how often the 1 to 2 gets hit and then reverses. Now, right here, if we went for the actual 1 to 2 target, which is the correct target that we should be doing for this strategy, we would have hit a full take profit, exited the market before price reversed, and been out, done and dusted for the day, up 2%, 4 grand, happy days. But if you targeted just a little bit more, 2.5%, 3%, you would have had the trade completely reverse on you and either held a stop loss or a break even, most likely. Now, again, this is the whole reason why I trade the 1 to 2s is because they're so consistent. And even when you don't have the right bias, and this is the key part, so really note this down, pay attention, etc. But with the 1 to 2s, even if you don't have the right bias, even if you're somehow wrong about the higher time frame, or you're somehow wrong about the direction price wants to push in, there's still a decent possibility that price is at least going to go in your direction far enough for you to hit that 1 to 2 and get out of the market before it comes back on you. And right here, you can see that clearly the overall bias, well, again, not really the overall, but you can see that clearly we were wrong about price breaking out higher, and we were actually still in the same sort of accumulation. It was more. It was one wick rejection that we caught essentially, but because we're only trading 1 to 2 and we're on a lower time frame, we've got a good entry. We hit that full target before price came back. You see what I'm saying? Again, I don't know how clear I'm being here with this point that I'm making, but this is the whole idea behind the 1 to 2. It's just about that consistency thing. It keeps your win rate nice and high. It means you're going on less consecutive losing streaks. There's just a lot of benefits to the 1 to 2, so I'd highly, highly recommend it. Now, right here, what I'm going to do is I'm going to spam another trade. Now, this is not an actual trade. This is not an actual position. Do not copy me. But I want to show you guys the analytical feature on the back end. And the only way I can show you this analytical feature is if I add in some more trades. So there's actual trading data. Granted, this is not something you should be doing. You wouldn't be reversing your position for no reason. It would just be silly for you to do this. But this is just simply for the purpose of gathering some more data so I can show you guys the back end. Right here, let's take another buy position, etc., etc. We'll just spam one more position. See what happens right here. We'll go for a little break even on this one. All right, there we go. Cool. Now, after you've sat here and you've gathered, you can then go back to the main page or your home page, and you can come right here, click subscribe, obviously, and you guys right here, exit the video, subscribe, all of that. You can come here to analytics, and on your analytics, it will give you a bunch of very in-depth insights. Very, I don't even know what I'm saying. A bunch of very useful insights. So if you guys aren't familiar, this is essentially what you have on majority of prop firms. You have a back-end analytics. You have a back-end metrics that show you your performance. So it shows you your total profit and loss, your P&L, your account balance, your win rate, the total trades you've taken, the amount of break-even positions you've taken, and you have a nice equity curve. Granted, we only took 3 positions right there, and 2 of them were fake positions anyway, so there's not really too much data to go off of, but just to give you an idea of how this kind of looks. It will show you your average risk-reward ratio. Now, this number should always be 2. It should be a minimum of 2, should be your average risk-reward ratio. That is the general idea. Granted, it may be a little bit lower because sometimes you may take profit beforehand for whatever reason. There's a certain time and place to do that. But generally speaking, this number should be 2. Your max risk reward ratio can be whatever it is. This is also a very useful statistic for refining your trading in the future. Now, again, we're going to have a whole session about refinement and how to actually improve your win rate. And these are very, very useful statistics to do that. But for the time being, it's not too important. You then have your average ideal. This, again, super important statistic. This shows you what you could have made. So the average risk reward ratio that your trades are usually hitting. So if you find that this number is higher than this number, then you're probably taking profit a little bit too early. And then you have a maximum ideal, etc. There's a bunch more statistics right here. Again, you guys can pause the video and read this stuff. A lot of very, very useful insights. You get your performance per day, so you can start to look at which days you're most profitable on, which days aren't too profitable for you. And right here, you have a whole yearly outlook. So from January to December, you can see it on a day-by-day basis and see little green and red boxes dependent on what days you're profitable on, etc. And you then have right here performance per month and your total P&L. You then also got some further trading session analytics that tell you about your win rate and the total trades, etc., according to the trading sessions you're actually trading in. Long story short, a bunch of very, very useful analytics. We're going to have an entire session going through all of this and going through how we can actually refine the data and just get better at doing it. But yeah, very, very useful. Highly, highly recommend FX Replay. I'm not even sponsored by these guys. I don't have like a discount code or anything I can give you. I don't get paid to say this, but I actually think FX Replay is sick. And personally, if I had FX Replay while I was coming up, while I was in my backtesting phase, I'd be an animal at this point. But I was backtesting on TradingView back in the day. Back in the day, I was doing all of this manually. So I'd be sitting there trying to calculate stuff, looking at my screenshots, looking at data, etc. And now you guys can pay like $30, which is like 20, 23 quid, 24 quid, and have an AI do it entirely for you. So I'd highly, highly recommend getting this. Now, just before we wrap up this video right here, because I know this has definitely been a very, very long video, maybe one of the longest videos on the series, and I don't know how clear this video has come across. So again, let me know in the comments, because I have been sitting there waffling, but I've just been trying to make a very long piece of content for you guys, so you can really sit here and just gain as much as you possibly can. But definitely let me know in the comments any feedback or anything you got for me. But in terms of how much data you should actually backtest, because I know I get this question on a regular basis, the more data you backtest, the better. It's definitely like there's no maximum amount to the data you can gather, but I would say at a bare minimum, an absolute bare minimum, you're looking at like 4 to 5 months of data at least. Now, from those 4 to 5 months of data, again, it depends on how many trades you find, how many positions you execute. There's a lot of variables that go into it, but you're looking for at least like 4 or 5 months of data. I would personally do the entire session on one like backtested period. So I wouldn't do it on a month-by-month basis, just so you can get these analytics a little bit more in depth and you can just have a larger sample size to work with. But definitely, if you can do like a year, 2 years of data, even better. It will just give you more insights. And then after you've done like a year or 2 years worth of data, you can then look at the analytics, you can look at the metrics, you can make some adjustments based off of this data, and then go back and backtest the same period. Now, I know it's super tedious. I know no one wants to redo backtesting and etc. But get over it. It's part of the process. If you want to become a very good funded trader, it's just something you're going to have to get good at doing, and you're just going to do it on a regular basis. So yeah, get used to it. But that's it. I'm going to leave the video here. I've still got a bunch of other work I need to do, but hopefully you guys enjoyed the video. Hopefully you gained some sort of value. Let me know what you think in the comments. And on the next video, we're going to continue to build off these concepts and just kind of develop the trading plan a little bit further.